Markets still going very strong, 2.5% higher on the mid-caps. And look at the advanced declines. It's almost reversing all the bad news of the week. 8 in the green for 1 in the red. Extremely healthy markets for the bulls at this point in time. So let's once again shift focus to the global turmoil that led us lower. Where is India in the pecking order after the storm or in the course of the storm? We'll ask Victor Schwetz of Macquarie, who joins us on the phone line from Hong Kong. Good morning, Victor. Thank you very much for joining us. First up, is the turmoil over or is the days calm?
Sorry, I didn't understand that.
Well, we've seen too much of, equity market, emerging market currencies and equities sell off. But over the last 24 hours, the currencies have definitely stabilized and the equity markets are doing well today. So should we think that the worst is over?
No, of course not. For a very simple reason. What we're seeing is a flow of tremors. One after another, and between the tremors, there are periods of stability. It doesn't mean that the worst is over. The worst cannot be over so long as the macro settings globally remain on the current path. So, in other words, what we've been doing for the last 9 or 10 months is withdrawing liquidity. If you look at the global liquidity, no matter how you define it, whether it's money supply, whether it's a public sector liquidity, whether it's a private sector liquidity or U.S. dollar supply, all of them have been contracting. And so we're withdrawing liquidity. At the same time, we're trying to raise the global cost of capital. And at the same time, we have a highly divergent outcomes. Some economies become highly inflationary, some remain disinflationary, some are accelerating, some are actually slipping backwards. In that sort of environment, the accidents happen all the time. And in fact, what you usually get, unless you change the macro settings, the markets react. And the only way to change macro setting is for Federal Reserve, U.S. and China to see eye to eye. Right now, that is not occurring. And so what it means, if you don't change macro setting, market change micro settings. And the classic micro settings are earnings per share expectations, multiples, spreads. And so what you're seeing regularly, the market tries to price in a much more extreme outcomes. And the reason is simple. If you look at almost any market globally, the earnings expectations are still incredibly high. Analysts are not cutting almost anything. Just look at India. Your expectations are 15-20% per annum growth in earnings, not for 1 year, for 3 years. In 18, 19, and 20. In other words, analysts expect no dislocation whatsoever. At the same time, if I think of the valuation multiples, they've somewhat corrected, but pretty much no market is really cheap. So what the market is doing essentially is trying to price it in, even as analysts are not really cutting numbers, and trying to reflect that sort of uncertainty. So to me, it's a rolling tremors. We already had 4 tremors this year. And I said, unless macro setting changes, and right now I don't see how, there will be more tremors.
Victor, good morning. In fact, we must congratulate you because when we spoke with you last, I think it was the first week of September, you said that India is going to be the next shoe to drop and, you were anticipating the fall. Since then, the market has fallen about 15-odd%. Particularly with respect to India, do you see more pressure? And what would your approach be towards markets like ours?
Well, India is interesting because there are actually quite a lot of pluses that investors can see in India. But at the same time, there are also significant minuses. And I think what investors are trying to do is to balance the two as much as they can. There is no question that investors were underestimating the impact much lower currency will have through the economy. There is no question that investors have been underestimating the impact much higher cost of finance is going to have. And investors were incredibly bullish and remain bullish on how fast the companies can grow. But on the other side of the coin, what you have in India is largely domestic, highly liquid economy, not exposed that much to foreign flows. And relatively low external vulnerabilities. In other words, you do run twin deficits, but there is a lot of liquidity within India itself. So what the market is trying to do is to balance it. Do I see India as a better market or not such a good market? To me, India is sort of somewhere in between. It's not, you would like some of the characteristics in India to be different, but there are still enough pluses there to stay in the market.
Victor, it appears that even the developed market equities, Wall Street indices, are trying to pressure the US Fed from its rate hiking intent. What are you pricing in by way of federal action, Federal Reserve action? And consequently, where can 10-year yields go by the end of 2018?
Well, it all depends on inflationary outcomes. The only reason you have a degree of relief today is because CPI missed in the United States. And remember, we're only talking of misses of 10 to 20 bips. 10 to 20 bips is within rounding error. Nobody really knows whether the number is 2.2 or 2.3 or 2.1. Nobody. And so because you had a miss in CPI, there is a perception of a little bit less inflationary pressures. And therefore, that implies that perhaps corporates will protect their margins a little bit better, and the bond yields don't need to go that much higher. So the key is really inflationary outcomes. And to my mind, I've never been a believer that wages are going to skyrocket. I've never been a believer that wholesale chain companies will be able to recoup the money. My only concern has always been commodities, and whether, in fact, through geopolitical and other factors, we are creating a supply-side shock in the commodity market, which at least temporarily can move inflation rates to a high level. That's always been my longer-term concern. But over the longer term, in a sense of years rather than the next month or two, I don't believe bond yields will go higher. I think they will be lower 3 years from now than what they are today, even 2 years from now than what they are today. So the way Federal Reserve looks at it, they look at it one point at a time, and looking at the data it comes through on a monthly basis. They're also utilizing, in my view, outdated models. And so the result is that you can't be in a tightening mode for too long. And that's pretty much what I think Federal Reserve is doing. They're looking at only through the eyes of the United States. They're not looking through the global eyes. In other words, U.S. is more inflationary, but the rest of the world is more disinflationary. And they are prepared to contract the rest of the world, hoping that the United States, generally speaking, in that environment should be okay.
So,
so that's your biggest concern.
Sure. Victor, the last time when we spoke with you, you had indicated that although emerging markets might underperform, you see this as a drift rather than a rout. Since then, the fall has exacerbated. Would you still believe that this is not a 2008 sort of situation? This is just a correction in an otherwise larger bull market?
Sorry, I didn't understand that. What we were expecting, I think what you're asking me, whether it's a drift or a collapse of emerging markets.
Yes.
I was expecting earlier in the year a drift, roughly emerging market losing 50 to 100 basis points every month relative to developed market. And therefore, at the end of the day, ending up with maybe 10%, 12% underperformance. We've done worse than that. We're down almost 20% against developed markets so far. Now, I still think it's more likely to be a drift as we go forward rather than a collapse. But there are three parties that will determine the extent to which it's going to be drift or collapse. One is Federal Reserve, the other one is Donald Trump, and the third one is China. If China continues to be confused as to its response, which right now they are confused, if we have any more tightening from a geopolitical and trade perspective, and if in fact Federal Reserve continues to believe that they are behind the curve, then the next shoe will be the next shoe will drop pretty quickly, and it could be much more severe collapse.
Okay. Well, we'll brace ourselves for that. Victor Schwetz, it was a pleasure speaking with you. Thank you very much for putting so much of the global turmoil into perspective. So it's not over, the turmoil. The temporary reprieve appears to be because CPI came in 20 basis or 2 basis less. But for the moment, we are celebrating.
Yeah, we are celebrating. And, 8:1 on advanced decline. We have 10,400 now on the Nifty. I think Wednesday high, Lata, was somewhere around 10,430. We want to see if we are going there. On the Bank Nifty, of course, we are seeing quite a bit of buying. So that clearly is interesting. I think the stock that's really surging now is Canfin Homes. Just pull out that stock intraday because there's a massive intraday move which is on in Canfin Homes, and it's 8% higher. Also keep an eye on Canara Bank, which of course is promoter of Canfin Homes. So Canfin Homes is up about 8%. You would have some part of that.
PNB housing is higher, so PNB is higher.
Exactly.
I mean, it's
and
working
today,
out for everybody.
It also looks like a bit of a PSU banking day. So a lot of these PSU and PSU banks are doing well. I think stocks like, Canada, Indian Bank, perhaps Union Bank is something where, you might have some shorts, and these stocks may start to see a bit of a short covering bounce now. We'll take a break. Up next, of course, we'll talk about HUL and the expectations from that company.